Hey folks, welcome to Quantsapp. Today we will understand how can we go ahead and capture the market volatility. How can we go ahead and monetize the market volatility. So there are two types of volatilities. First one is historical volatility. As the name suggests, how it is calculated based on the historical movements of the stock. So basically it's nothing but how much movement the stock has given on day basis. It is calculated using that. Okay. Now historical volatility is nothing but you can say how volatile the stock has been in the past. Generally, people take a look back period of 20 to 30 days to calculate the historical volatility. More the historical volatility, more volatile the past was, less the historical volatility, less volatile the stock's past was. Now, here comes implied volatility. When we are trading options, the best part is we have something known as implied volatility, which is nothing but a forward looking volatility. What is implied volatility? It is traders' expectations about the volatility that may play out in the future. If I'm placed on 12th of June or 12th of July as I'm recording this, what are my expectations about the future is shown to us by implied volatility. Historical volatility is past data. It is calculated based on past data. Implied volatility is forward looking. It is using past data to calculate the implied volatility, but it also uses option premiums. In simple words, implied volatility is forward looking volatility. It is trying to estimate the volatility that may play out in the future. How it is calculated? It is calculated using option pricing, the price of the option right now. Now, how can I go ahead and monetize implied volatility? As we are trading in options, we can go ahead and monetize implied volatility just by looking at the behavior of the implied volatility. For that, let me just take you to IV chart. So let's say IV chart. By the way, you can access the analytic from the link in the description box below, or also there it would be there in the iCard. So orange line over here is showing us implied volatility on what day what implied volatility was of HR Motors. Now, if you just look at this chart, what you can see? You can see that there is no trend whatsoever in the orange line. What is orange line? Orange line is implied volatility. So implied volatility is mean reverting in nature. It will not trend. Okay. So let me just show you Nifty. Yes, the regime can change. First, it was trading in this regime. The regime has shifted like this now. The regime can shift, but it will not trend. Now, if you see market, so just check out Nifty.
Hey traders, Quantsapp has simplified option trading analytics for you. Click the link in the description box below, complete your sign up process and access the most advanced option analytical tools in the entire industry. Thank you.
It has been trending in the upwards direction, right? Now, but that is not the case with implied volatility. If you see, if it is going at the top, at some point it will correct. If it is too much at the bottom, something like this, it is likely to spike up. So now we are using implied volatility to trade because it is very easy to predict. We know this is the top and this is the bottom. If it is here, we know that the implied volatility will go up. If it is here, if it is at the top, you know that the implied volatility will go down. So just because of the characteristics, which is very easy to predict, we are going ahead and trading implied volatility. Now, how I am going to trade this using options. So it's simple. I'll just show you. So let me just take you to option chain tool now, just to show you impact of volatility, the impact of implied volatility on our option premium. Let me take you to what if analysis. Now, what is this? This is nothing but a premium calculator. You can say it is calculating the premiums of the entire option chain if a specific parameter in the entire option chain changes. Okay. So over here you see there are premiums on the left hand side call options, right hand side put options. If you move around the date, you will get to see that so basically it is trying to tell us 4 days from here, if IV remains unchanged, underlying remains unchanged, which is Nifty, this premium will go down by 21 rupees. This premium will also go down by 21 rupees. Now here I am explaining you this one, which is implied volatility. Let's say if the implied volatility goes up by 10%. So the call premium will go up by 14 rupees and the put premium also will go up by 14 rupees. As you can see, 14.64 is the change in the current premium if implied volatility goes up by 10%. So if IV goes up, one thing to notice that the call option will also go up and put option will also go up, considering all other things remaining constant. If market doesn't move at all, days to expiry remains also the same. But only if the IVs go up, the call option will also go up and the put option will also go up. That is the first characteristic. Coming to the second characteristics, let's say if the IV goes down by 10%, then what happens? Now you see the call option is also going down and the put option is also going down. So IV is positively correlated with the option premium. Goes up the IV, goes up the call, goes up the put, goes down the IV, goes down the call, goes down the put. Considering all the other things in the market remaining constant. I'm saying I'm not a trader who can predict underlying price, but I can predict one thing, which is IV change. How? Simple, by the mean reverting characteristics which implied volatility had. So now it's simple. If IVs are at bottom, IVs are likely to spike up, due to which the call premium is likely to spike up and the put premium is also likely to spike up. This is the first trade. Second trade is wherever the IVs are at top. From there, the call premium might collapse because of fall in IV and the put premium might also collapse because of fall in IV. So we got two easy trades over here. Only thing we need to do is just check if the implied volatility is at the bottom or at the top. Whenever it is at the bottom, we can prefer strategies like long straddles, long strangles, buying of call options, buying of put options. Basically, be more inclined towards the buying side of options, not selling side. Because why? If the IVs in the market go up, the premiums will start becoming expensive. That is the first thing. Coming to the second thing, whenever the IVs are at top, we will prefer strategies such as iron flies, iron condors. We will not do short straddles or strangles because they come along with undefined losses. Simple iron flies and iron condors, they will be hedged at all given points. You will not face an undefined loss. So yes, folks, that was it from my side. So it's simple. Just check out for where the implied volatility is placed. Is it at the bottom or is it at the top? And accordingly, capture the market volatility very easily, very seamlessly. You can use IV chart analytic in the app and just check if you see now that the IVs are at spiked up, if they are at the top, that means they, that is the time to create short volatility option strategies, and whenever it is at the bottom, that is the time to create long volatility option trading strategies.